we have an exciting meetup and really exciting guest, Sarry Ibrahim. This is the Power of Passive Investing meetup. We welcome everyone to our meetup. So our meetup is all about helping people in different ways. So today's topic is how to use infinite banking when investing in real estate. Sarry is a financial planner. He is also a member of Bank on Yourself organization. He helps real estate investors, business owners, and full-time employees grow safe and predictable wealth, regardless of the stock market condition, using financial strategy that has been around for over 160 years. Sarry started his own journey when he was still in graduate school doing his MBA. He worked at a bunch of companies such as Allstate, Blue Cross Blue Shield, Cigna, Humana, before he joined the financial asset protection program and became the financial advisor. So now he focuses on bank on yourself concept, and that's what he's going to share with us tonight. This is the usual disclaimer. This is for educational purposes only, not selling anything. We have the typical housekeeping rules. We ask everyone to mute themselves while we have the presenter going. And then at the end, feel free to unmute yourself, ask questions, or post your questions in the chat, whatever you prefer. And then our next event is on June 2nd, believe it or not. Yeah, June is around the corner. It's going to be 10 principles to get the most out of yourself and perform at the highest level. And by popular demand, Dr. Jamil is coming back, and that's the topic that he's going to cover. For those that were with us for the goal setting workshop in January, you still remember Dr. Jamil. A lot of you have expressed interest in hearing him again, and so we're bringing him back for that. And then two more exciting meetups after that. One will be by Emma Powell. She's going to talk about Ponzi schemes and the scams, some that she was personally part of, some that she is aware of through friends and family. And after that, again, by popular requests, we'll have Ryan go over the most famous Michael Blank's analyzer, the underwriting analyzer. So that's going to be our meetup in July. Let's see. This is my contact information, but I'm sure by now everybody knows how to find me. My company, Instagram, Facebook, and so forth. Even on Clubhouse, I have been there 4 times at this point. So yeah. You can definitely find them connected. That is all I have for today. Let me stop sharing. And ladies and gentlemen, I would like to welcome Sarry to take over the floor and give us his powerful presentation.
Thank you, Alina. Thank you so much for having me. And thank you for the warm introduction. I'm just going to share my screen real quick. Can you see it?
Yes, we can see it.
Okay, perfect. Great. So as Alina already mentioned, my name is Sarry Ibrahim. I'm the CEO of Financial Asset Protection. It's a financial services firm in Chicago, and we focus mostly on the infinite banking concept, specifically for real estate investors. So I'm really excited to be here and to share more about how we could do this. Also, I'm the host of the show Thinking Like a Bank, where I had Alina on. She was on episode 6. So check out that episode afterwards. I'm trying to give you an idea of what we do. The infinite banking concept is also known as the bank on yourself concept. It's also known as the bank on yourself strategy, or cash flow banking, cash flow insurance. It has a lot of different names, but the underlying asset is the same. They just have different trademarks that talk about it. And I'm going to talk about today the underlying asset in a few minutes, but just to kind of give you an idea, it is interchangeable with different concepts. In case you've heard of like bank on yourself or infinite banking before, they do go hand in hand. Before I get into what the concept is and how it could be used for real estate investing, I want to talk about two common problems that a lot of real estate investors have and small business owners have. And we see this from our clients and from doing a lot of other research. We see that two common problems are taxes and interest. Taxes in the sense, of course, just common sense that the more you make, you're going to have to pay more in taxes. And yes, there are a lot of deductions and methods for reducing your tax liability. But from a conventional standpoint, that's mostly done on a short-term basis or an annual basis, meaning every year, how much do I reduce my taxes by every year as much as possible? That's kind of the traditional way. And I'm not a tax professional, I'm not a CPA, so consult with your CPA before doing this. But a huge benefit of utilizing infinite banking is reducing tax liability, not just short-term, but also long-term in the future too. So actually having like a tax-free retirement, and especially having with real estate investing, that goes really powerful. That's kind of one common problem. And the other is interest. So again, back to real estate investing. If you're an active real estate investor and constantly pursuing, if you're constantly pursuing banks for financing, as you're growing, as you're increasing your properties and your portfolio, you're probably taking on more debt, which means that you're paying more interest to banks. So you're actually essentially working for the banks, bringing in them more business and providing them more passive income to the banks. And let's say the opposite of that. Now, let's say you don't use any debt at all. You use only cash to finance all your properties or all your investments. That's also a loss there too, because there's a loss of opportunity cost when you're using cash. You lose the opportunity cash you could have earned had you had invested that money somewhere else. So I really want to address these two problems utilizing using infinite banking, especially for real estate investing. Now, the next slide, I'm going to actually dive a little bit deeper into what is infinite banking, more on a basic level. It is utilizing life insurance, but there's pretty much three different types of life insurance. There's term, whole life, and universal. Term, for example, let's say somebody is 40 years old, they do a 10-year term life policy. It expires at age 50. They have the option to renew it if they want to, if they can go through underwriting again. Typically at much higher rates. There's no cash value. It's similar to renting. You only have it just for that set period of time, and there's no equity or cash value you have with you. Whole life obviously is the opposite of that. If somebody, for example, is 40 years old, they do a whole life policy, it's going to be good for their whole life, technically until age 121. And you also have cash value in the policy. You have like a savings component or a savings portion in the policy that's growing and earning interest and dividends. And that's what infinite banking is. It's utilizing in the whole life policy and the cash value inside of it for self-banking purposes, for you to become your own source of financing and for you to grow wealth predictably over time. It's also similar to owning instead of renting. You have, for example, in your home, you have the market value and you have equity. Same thing here in whole life. Universal, on the other hand, was made in the 80s for insurance companies to compete with mutual funds and investment groups and banks. The problem with universal life is that it's not as predictable as whole life. I don't want to get too far into life insurance. I want this to be about infinite banking and about real estate. So for just to kind of make it basic, it's going to be whole life insurance and the cash value. And then just so we understand what that is and why we're talking about whole life insurance to begin with. Now, why whole life insurance and why infinite banking? Like, why these two together? There's 7 actual reasons why that are very powerful that you'll see in a few minutes. Okay, so number 1, the growth of the cash value and life insurance both grow guaranteed and predictably every year. There's something called an illustration that you're provided with when we work with you that shows you how much cash value you have in relation to the premium dollars and death benefit. And these are predictable and guaranteed. The insurance companies we work with are mutually owned insurance companies that have been in business for over 100 years. The way they operate is a little bit different from how investment groups operate and banks and hedge funds. They are highly regulated and could only invest in conservative investments. So this way, for example, let's say in this situation right here, you have $170,000 in cash value. Something happens in the stock market, something happens in the economy, there's another COVID, something else happens like that. The policy itself, the death benefit, are not hindered by market conditions. So that's a really important reason for real estate investors to have safety of principle. There's a book called All About Annuities I was just reading, and the author mentions that if you were to take all the life insurance companies in the United States and pool all their capital together, this is just life insurance companies in the United States, you were to pool their capital together, they would have more cash than all of the banks and oil companies in the world combined. So that translates into there's a lot of safety of principle behind using mutually owned insurance companies, life insurance companies, or the infinite banking concept, a lot of safety of principle behind that. And then also another important reason too is guaranteed liquidity. This means that at any time, whatever your cash value is in your life insurance policy, you can leverage that. You could borrow against that. You could technically borrow up to 90% of that. You don't have to qualify for the loan. You don't have to give up collateral other than the policy itself. You don't have to go through a credit check. You don't even have to promise to pay back the loan. You could borrow on your own terms and pay it back whenever you want. This is exactly where it comes in with real estate. If you're an active investor, you can use this policy to finance your properties. And then if you're a passive investor, you could use a policy to invest in passive deals. So whatever you want to use that money for, you could use it, which is where the term comes from, bank on yourself. You can literally bank on yourself, borrow from yourself at any point. It's a very powerful method, especially in a situation where banks aren't lending out money. You can come out as a competitive real estate investor by having your own source of financing that guarantees you loans when other banks or other lenders won't. Here's an example right here. Let's say, for example, column one, you have $12,201 in cash value. At any time, you could borrow up to 90% of that. And the same is true for the following numbers below that. Number three, reason taxes. So we started off talking about how taxes are a problem. So typically with utilizing infinite banking, it is a post-tax saving strategy. That means that you're technically, you're making money either through W-2 employment or your business, paying taxes on it, and then funding your policy. Then when you do it that way, your policy grows tax deferred, and you've converted into the 0% tax bracket. There's actually a book called The Power of Zero that talks about going from whichever tax bracket you're in into the 0% tax bracket. So now let's say, for example, you're funding this policy, you're growing it, you have cash value in it, and then taxes right now go from the highest rate right now is 37%. Let's say it goes from 37% to 50%. And we have reason to believe that taxes will go up in the future. So this can be a hedge against the spike in taxes. Also, in most situations, the withdrawals are tax-free. The only times the withdrawals are not tax-free is if the policy is called a modified endowment contract. If it is a modified endowment contract, then you could be on the hook tax-wise for the withdrawals. But in most situations, and this is something your advisor needs to be aware of and needs to do, is that we set up the policy so it is not a modified endowment contract. In other words, it is a tax-free, it's tax-favored policy. It grows tax deferred. When you take the money out via loans and withdrawals, those are also tax-free. Even if there are gains in the policy, it can come out tax-free based off of current tax law and based off of how insurance companies structure these policies and how the advisors structure the policies. Another cool thing too is when I talk to a lot of clients, they'll say, one of the first questions is how much do I get into the policy? What are the rates of return, the average rates of return in the policy? And they're very conservative. They're typically between 3 and 5% every year. And then a real estate investor might say, well, that's cool, but I'd rather get 8% or 12% doing real estate on my own or actively or passively. And I explained to them that this is not an either or position. It's not either we do infinite banking or we do real estate or other investments. Rather, it's a way to connect all of these together. It's a very powerful way of doing so because we address other problems. In other words, you can fund a whole life policy. You can build up the cash value in it, grow it over time, and then borrow against it, again, used for active deals or passive deals. And you don't have to give up one over the other. There's one thing I want you to remember is that this is not meant to replace anything you're doing. It's meant to fill in the gaps or missing buckets of your portfolio or other things that you want to accomplish using infinite banking. So again, this is not an either or situation. Rather, it's a way to do both. And you could do whole life insurance and real estate investing specifically through the way that the loans work. That's arguably one of the most powerful ways that it's done is through the way that the loans are done. Number 5, there's no limits on how many policies you have or how much you can add into the policy. Like for example, with 401ks and IRAs and other qualified accounts, there are certain limits. Like for 401ks, it's $20,000 a year that you can add into it. With life insurance, you can have as many as possible. The only limits there are pertain to the insurability of the actual person, meaning that the insurance company is going to look at how much you make, and they insure you based off of that in that given year. So here's an example right here. So let's say, for example, in this right here, this death benefit right here is $1.1 million. The insurance company is going to say, okay, this person, how much do they make? They might ask. I would say they make, $100,000 a year, for example. Now they would say, okay, you could take 100,000, multiply it by 25 times, which brings us to $2.5 million. This person can get technically up to $2.5 million in life insurance. They could do this policy plus another policy that'll equal $2.5 million in death benefit. That's one metric they use. Another metric they use is they would do 5 times your annual income. So in this situation right here, 20,000 times 5, roughly about $100,000 a year. That's another way they could do it too. And you could do numerous ones. So let's say, for example, you are going through some changes, like My brother-in-law right now is a resident, he's a physician, and he's obviously going to make a lot more money in the next few years. So he's doing one policy, it's a small amount. And then as he makes more money in those later years, he's going to do more policies with higher limits. So there's no limits on how many policies you could do, which is a really nice thing about this, is that you're not locked into certain brackets like permanently. You can kind of go through different stages and add on more policies based off of how your income is increasing over time. Number 6, this is very powerful. There's a lot of asset protection behind using infinite banking and using whole life insurance policies. No, they're not the funds that are inside the whole life policy are not it's not public information, and they can't be leveraged in most states by creditors. They're usually exempt assets. This is something, I'm not an attorney, talk to your attorney about this, but there's a lot of asset protection behind infinite banking. This is something that the wealthy have been doing for over 100 years. Especially the wealthiest families here in the United States have been using these policies to have self-bank, their own banks, and to leave multi-family, multi-generational wealth over time, bypassing estate and asset obstacles using these concepts. It wasn't called infinite banking 100 years ago. Infinite banking, the term is about 20 or 30 years old, but the underlying asset, which is whole life insurance, used in this way, has been around for over 100 years and has been used to protect assets and to keep wealth flowing from one generation to the next generation, and which connects us, so for example, if you look at, these are actual citations or statutes, state statutes in Florida, it's exempt, in Hawaii and other states too. At the end of this webinar, at the end of it, I will include a PDF that you can reach out to me, and I'll show you all 50 states and the laws pertaining to each state about how life insurance is viewed as in terms of bankruptcy and in terms of if it's an exempt asset. And then number 7, of course, even though we're talking about self-banking and using this for real estate investing, there's still the actual life insurance component that needs to be addressed too. You could use this, of course, for the life insurance part and for the self-banking part and for real estate all at the same time. It's multiple dollars used in multiple ways that could address it. For example, with term, it would be very difficult with term because the policy would keep terminating. You would have a 10-year, 20-year, 30-year policy that would keep terminating and keep increasing in value. With whole life, it would go all the way until age 121. So this means that you can take care of all your financial goals, all your retirement goals, and still address the concern of having life insurance. I used to work at Allstate Insurance, and I called a client one time, and I was talking to the client about connecting him with a financial advisor that helps with life insurance. And the client was like, I don't really need life insurance right now. I'm not going to die soon. And that kind of draws up 2 questions. Like, number 1, philosophically, we never know when we're going to pass away. And then number 2, if you were going to pass away soon, the insurance company wouldn't insure you. So you want to get this done, when you're young or when you're healthier. And then, hopefully the policies will, take care of themselves. And of course, addressing what we're here to address is it's real estate investing. This doesn't apply to every whole life insurance company or product in the whole country. There has to be 4 things that need to be addressed. Number 1, it must be whole life insurance. Just to kind of reiterate that, it has to be whole life. Number 2, there has to be something called a paid up additions rider. Not every company offers a paid up additions rider. So you need to make sure that they have a paid up additions rider. This is the part of the policy that helps increase or turbocharge the cash value over time. So you need to make sure that's there, because we're obviously using this for self-banking. We're using this for liquidity, for real estate. We need to make sure that the paid up additions rider is there. Number 3, we need to make sure it's a mutually owned insurance company and not a stock-owned insurance company. So a stock-owned insurance company gives their dividends and profits back to the shareholders, whereas the mutually owned insurance companies give their dividends back to the policy owners. So you want to be able to recoup those dividends or the cost of insurance back into your policy to help increase cash and to help create more liquidity so that we can buy more assets, and it keeps snowballing and going. And then number 4, non-direct recognition. If you remember, we talked about loans. When you borrow from the policy, if it's a non-direct recognition, when you borrow from the policy, they will not recognize that loan, and then they'll keep paying you interest and dividends on your money as if you never touched it. So let's say, for example, you have $100,000 in cash value. You come across a deal, you borrow $50,000 from the policy. In a non-direct recognition situation, the insurance company will not recognize that outstanding $50,000. Instead, they'll keep paying you interest and dividends on $100,000. So this way you have growth, compound growth in your money while you're using it. If it's the opposite of that, if it's a direct recognition company, then your interest and dividends will be reduced based off of that outstanding loan. Here are some examples of how you could use the policy. If you're an active investor, you could buy a policy using you could buy a property using your policy, or you can even use it alongside a down payment if you're using a bank to finance a property. And then you could use the rental income to pay down the loan back to the insurance company. Now you're left with both you have the policy appreciating and growing, and you have the property appreciating and growing. So you have two different assets growing with the same dollars used. And then the other example could be if you're a passive investor, you could borrow from the policy, invest in passive deals, and then the distributions you get from those passive deals, you could use that to pay down the loan. And then also too, let's say, for example, you're a hard money lender. You can go to the policy. Typically, interest rates are about 5% to borrow from the insurance company. You would borrow at 5%. You could turn around and loan it out to somebody at 12% as a hard money lender or private money lender. Now, two things happen here is that you have the split between 5% and 12%. That's one profit there. And the second is that you have the policy continue to grow through the non-direct recognition feature. You have it continue to grow. So your money is doing two things for you at the same time. There's many different ways that you could use it. I wouldn't have enough time during this webinar to go through all the ways that you could use it for real estate or business. These are just some examples. Some people even use it to pay down debt. So many different ways to use it. It's a very interesting and intricate concept that could be used in many different ways. If you want to connect with me, you can send me an email. My direct email address is sarry@finassetprotection.com. The name of the company is Financial Asset Protection. We just want to make the domain name shorter by calling it Fin Asset Protection. Our website is finassetprotection.com. You can call me at the number here, 708-717-6718. You can also visit our podcast. It's called Thinking Like a Bank. It's on all major platforms. It's on YouTube. It's on everywhere else. Thanks, Alina, for having me on and for having me do this. And if anybody has any questions or answers, I'll be more than happy to answer them.
Sarry, that was phenomenal, brief, clean, short, and sweet. Love it. Okay, let's see, guys. Again, feel free to either unmute yourself, or I'll check if we have any questions. So, I guess first question: what is SBO?
Oh, sorry about that. Small business owner. I should have said that earlier.
Fine. Looks like you love Jackson just put a comment. I picked up second one last year as long-term care rider.
Okay, I have a question for Sarry.
Go ahead.
Do you have like a case study as far as like an example with a person who has done this and how they used it for real estate?
Yeah, definitely. So one of my clients, he did something called a single premium policy. This is where it's a one-time policy. So he had about $400,000, and it doesn't have to be $400,000, but this was the client that did this. He invested $400,000 into a whole life policy, and then immediately had $375,000. So he started using that policy to buy out properties completely outright. So he became like his own mortgage, essentially. He would find properties and then now use the policy to do that. The reason why he did it that way is instead of just skipping the policy is that he wanted to, he was an older man, so he wanted to keep his life insurance part, the component there too, while still having the liquidity. He didn't want to tie up all his capital in different places. So he wanted to keep it moving by investing in real estate and becoming his own source of financing. So he got to control the loan payback period and the terms of the loan.
Okay, so somebody like me, I'm 26 years old. How would the whole life, what is the whole term life insurance policy work?
Yeah, definitely.
I'm 25, 26. I own a home, and I don't know, I have like $5,000 saved up.
Yeah, perfect question. Yeah, good. So when I first started my policy, I did $300 a month. So a lot of people could do that too. It depends on how much we always do a financial analysis with all our clients. We go through their income, we go through savings, we go through if they have 401k, IRA, if they're investing in real estate actively or passively, we go through everything. And then from there, we try to position, we also go through their objectives. And then we try to connect infinite banking to their objectives. So like, for example, are you a real estate investor right now?
No, I just own a home because I'm starting to get into the investing. So I'm like at the very beginning, and I have income, I have a salary, but it's limited, right? I don't have any other way to make more money. So if I want to buy additional properties, I have to keep, saving up, paying down this property until I get to that point where I can buy something else. So I don't have a workaround,
Okay, yeah. One, I don't want to give too much advice because I don't know exactly your situation, but one thing that you could do is you could do a policy like $300 to $500 per month, like the one I started, and then save in that. And then from there, you could borrow against it at any time. You'll have cash value. You could borrow, even if it's gonna be a small amount in the first couple of years, you could borrow against that and then use that. Because here's the thing. Let's say, for example, you save $5,000 over 5 years. Let's just say, for example, $1,000 a year over 5 years. So you're saving, and then let's say you use all that $5,000. That brings you down to zero. Now let's say you do the opposite. Let's say you borrow $5,000 and then pay back $1,000 a year, excluding interest. You pay down the loan. Now in 5 years, you're in the same situation, whether you borrow that money or you save that money, you're in the same situation. This is where this could come in, is that you can grow the policy, borrow against it, and it keeps growing, and you pay it back on your own terms. So this is something that you could do from now, especially since you're so young, is that you could do a policy with $300 to $500 per month that'll grow substantially over time, and then hopefully do more and more policies over time. And that way you'll never have an interruption in the growth of your money over time.
Okay, thank you.
No problem.
Awesome. Next question. How long before you can access your capital, and is there any way to accelerate that time frame?
So the cash value in the policy is based off of the premium dollars. So somebody who puts in, for example, $1,000 a year versus somebody who puts in $100,000 a year is going to have the person who puts in 100,000 is obviously going to have a lot more cash value. It's actually proportional. So the more money you put into it, the more cash value you have. Now, one thing we always do is we try to address like what is the intent of it? What's the purpose of it? This is where the analysis comes in. Like, for example, if somebody wanted to save over the next 10 years, we would have a specific goal for that. To accelerate the cash value, this is where the paid up additions rider comes in. It helps increase that cash value over time. But this is definitely, I think overall, it's a long-term strategy, and it's a way to save more and a way to kind of recoup that interest back into your life and the other benefits talked about. So it's kind of difficult to start something and then increase it directly that way. It has to be over time. It's a saving strategy over time. I hope that makes sense. I hope that question makes sense.
Sure. Looks like I skipped one. What is the typical loan term if doing the borrowing option?
Okay, so when you borrow at 5% simple interest. This is from the insurance company. They loan you the money. So now it's like a personal loan between you and the insurance company. You could pay that loan back on your own terms whenever you want. So you can pay back next month, next year, over 10 years, over 15 years. One general rule, and it's kind of hard to measure this, is that you want to pay it back within reasonable time. So you want to pay it back. So this way, when you pay it back, you have the opportunity to keep borrowing over and over again. That's a huge benefit of this, is that it's called infinite banking, because you can kind of do it over and over again an infinite amount of times.
When you say reasonable time, what's reasonable? A year, 5 years, 3 years?
So you want to compare it to other forms of, for example, financing a car. Typically, it's 5 years. So if you were using the policy to finance a car, a reasonable would be 5 years. If you're using the policy to buy a house, 15 to 30 years would be reasonable. If you're using the policy to finance a vacation, maybe 1 year to pay back. So that's kind of how you want to do it. It's compare it to other lenders and then how they would look at it and based off of that asset or that thing that you were buying.
Mm-hmm. Okay, excellent. Let's see. If I get a whole life for a child, 10 years old, at what age they can start to borrow money for investing?
So technically they could do it. So the parents would obviously be the owners of the policy. The insured would be the 10-year-old child. Technically they could borrow year one, depending on how much there is. Now the cool thing about this is that you could turn over the policy to the child after college, after they finish college, or even before college. If they're 18 years old, you could turn over the ownership to them. So this way you can kind of gift them the policy, or you could say, I'll give you the policy after you finish college. And the reason why I want to kind of dive into this a little bit deeper about the kids policy is that in a lot of states, there are 529 college plans. But the problem with 529 college plans is that they're regulated in the sense that you have to use those dollars for school. Except for infinite banking, you don't have to use it for school. So you can have this plan that for your child, growing, compounding, they could use it for college to leverage it, or for anything else they want to do.
So, sorry, it kind of to add on. So when you said gift the policy to a child, is that gift tax-free?
Yeah, I think gift is the wrong word to use. It's just you're changing the ownership from the parents to the children. The whole gift tax thing doesn't really apply here. It's mostly changing the ownership from the parent to the child.
And do they have to be under 18 to do that?
To be so technically, no, you don't have to be under 18. The parents could own, like anybody could own a policy on anybody as long as there's insurable interest, like parent, child, employee, employer, investors, partners. Anybody could own a policy on somebody else or insure somebody else as long as as long as there's insurable interest between the two parties.
When you say insurable interest, meaning who gets that interest?
Insurable interest meaning like is there a reason why you're like, for example, a father or sorry, somebody who wants to insure their parents or parents that want to insure their children, there's reason behind that. The parents want their kids to go to college. They want a financial vehicle. They take care of the kids. So they want to be able to pay for their college using the strategy. That's insurable interest. Or an employer has an employee that they want to retain over time. They want to take care of that employee. They can use infinite banking to do so. In other words, the employer could be the owner, the employee could be the insured. That would make sense. In other words, the underwriters have to look at it as like, why are these people insuring each other? If it's two friends, it probably won't work that way. There has to be financial reasons as to who's taking care of who and why.
So typically between family members, it makes sense.
Gotcha. Yes.
Okay. Excellent. Next question. If I put 300K into the policy today, when can I access that capital?
So if you put in, for example, if you did a single premium option, you did $300,000 today, then you would just do a one-time payment, $300,000, no other payments needed. And then tomorrow you'd be able to borrow about 200, and kind of just doing rough math, you'd probably be able to borrow about $280,000 tomorrow. That ends. And then you could pay that back whenever you want. And then while you're paying that back, your money's compounding and earning interest and dividends. The only thing is, I'll say from now, is that if you did the single premium option this much, $300,000, it's going to be a modified endowment contract. It doesn't meet the 7-pay test of the IRS. So they're going to view it as a modified endowment contract. So you get all the benefits we talked about, except for the taxes. That's going to be a little bit tricky. The withdrawals will be taxable over time if you did the modified endowment contract.
Great. Next one is kind of long. I'll read it. Hopefully. Okay. Hopefully we got it. So the 5% charged by insurance company to loan the money to you, does that 5% get paid back to your account balance, or is that a fee that is taken by insurance company? Or should we think about 5% more similar to a mortgage interest rate, or is it the rate at which we have to pay back into our account?
Okay, so when you borrow the money from the insurance company, you're borrowing from the insurance company's general funds. So it's a loan between you and the insurance company. The 5% interest goes to the insurance company. That's another form of revenue for the insurance company, is charging interest. But while you're doing that, your policy is earning interest in a separate account in a different way. It's earning interest. So that's kind of how it hedges against each other. So that way it actually comes out higher. You actually come out higher because you're earning compound interest in your policy and you're buying the money you're borrowing at simple interest. I hope that, let me see if that answers the question.
I think so, yes.
Okay.
Question was,
Yeah, that was helpful.
Okay, thanks.
Thank you, Matt. What is the what are the insurances for God kids?
This is possible. It's a little bit tricky because it goes back to what was mentioned earlier. It has to be insured. It has to be a reason why you're insuring the kids. If financially responsible, that could be. I think it would depend on the underwriter and the company. We have about 4 different insurance companies we work with, so I'm sure at least one of them will be able to accept that.
Makes sense. I heard of business partners get an insurance for each other and their business and venture, like buying a property together. And if one of the partners dies, then they can predetermine a beneficiary and how the partnership will end up. Do you know of the strategy? And if so, can you explain it in depth?
Yes, yeah. So this is called, it sounds like it's called a buy-sell agreement. This is, for example, 2 partners, they own a business. They insure each other. If something happens to one of the partners, the other partner will be the beneficiary. So it's kind of, they're both insured. They're both the beneficiaries. If one of them passes away, the other one is a beneficiary. And the reason why that's important is so that way, let's say, for example, it's $1 million life insurance on each. And the partner, one of them passes away, the other partner would get $1 million. But it's not to get $1 million just to keep it. It's to take that $1 million and then to buy out his partner's shares from the family. And the reason why that's important is because business partners never want unexpected partners or new partners unexpectedly. They don't want, for example, the partner's wife or husband or son or daughter or somebody else to come into the business now, because it could change up the whole business operation. It's typically a conflict when that happens. So the buy-sell agreement helps prevent that from happening. If something happens to one of the business owners, the other business owner becomes a beneficiary. They get that the death benefit, and they could use that to buy out the other family shares. So this way, everything keeps moving in motion without any unexpected partners.
But so they need to have a property or a business together in order to get this insurance. Okay, makes sense. Great presentation. When is infinite banking not a good fit for investors? Good question.
Yeah. Thanks for asking that. So I think that it's definitely a long-term, so it's a long-term move. If somebody is definitely hooked on like more short-term moves, more short-term planning, this will not be a good fit for them. So for example, when you start out infinite banking policy, it's not for every dollar put in instant liquidity. So if you were doing a policy that's $20,000 a year, your cash value year one might be around depending on the age and the company, might be around $13,000 to $15,000. So there's a little dip in cash value to premium dollars put in. But over time, you end up getting through interest and dividends, you end up getting the entire policy back, the break-even point, plus more, plus all the benefits, the tax benefits and everything else. So if somebody is really focused on the first 1 or 2 years, this would not be a good fit for them. This is more of long-term, I'd say at least for the next 10 years, 10 years and up. And of course, if, for the younger people that are 25, 26, this could be, a 40-year solution until they're age 75 or 76, or even, longer. But typically, if it's somebody that's constantly more on short term, and especially somebody who kind of invests all their money, this would not be a good fit for them.
So, sorry, correct me if I'm wrong, but if someone puts a policy today and let's say wants to start using it in 5-7 years, even if they use it for short-term projects, let's say they flip in houses, that still works. You're saying that you need some time for the policy to build up, and then the duration of a project at that point should not matter. Is that correct?
Yeah, definitely. Yeah. It depends on how much it's going into and the properties. But yeah, overall, I think just a kind of a good idea is that it takes a few years to build up the cash value. It takes a few years to get the cash value up, but you don't have to wait a few years. That's just technically when the policy starts to make some, depending on how much you're funding it with, starts to make some impact on what you could actually use that policy for.
Sure. And I don't know if everyone got your contact information. Maybe you want to type it in the chat again.
Yes.
So people can connect and reach out if they want to speak with you personally.
So that's my email address. And then if you go to our website, actually the best way to contact me, the fastest and best way, if you go to our website, you could just schedule an appointment directly. finassetprotection.com. There's a Calendly link. You can schedule an appointment there. And then I'll actually send you a free copy if you reach out of the book, Becoming Your Own Banker by Nelson Nash. Nelson Nash invented the infinite banking concept. So I'll send you a free copy of that book if you reach out as a thank you for joining us. And I'll send you a free copy of the book that talks about the entire concept. It's like a 70-page PDF. You could probably read it in 1 day. And it has all the information about infinite banking in it.
Yeah, he's considered like the godfather of infinite banking.
Yeah, he invented it, exactly.
Yeah, excellent. Rick, I see you unmuted yourself. You're ready to ask the question?
Yeah, if you're done for the time being, I'd like to get a question or two in. Sarry, you explained things very well, and I know by experience, with the business partner, $1 million on each, you explained that excellent. Just wondering, I'm a former licensed. First license was 1980. Where your parents didn't even meet yet, did they? As a first insurance license. Anyway, question on universal life. Non-direct benefit. Does that apply to universal life, the ones in the late 80s that came out?
Yeah, just to be upfront with you, Rick, I don't know. I don't do any universal life. So I don't know if the non-direct part or feature would apply with universal life policies. And just to be clear, your question is, So if that means that, for example, if you had $50,000 in a universal life policy and you borrowed against it, would your cash value be affected by borrowing?
Yeah, exactly. Where you would, get the full benefit if you borrowed against it, correct?
Mhm.
That's the one I saw where you had that in the whole life.
Mhm.
So I was just wondering if that is particular to universal life, also the ones that came out in the late 80s.
Yeah, to be transparent, I don't know. I'll actually do research. If you send me an email, I'll do research and get back to you on that if universal life does apply. Do you have a universal life policy?
Yes,
Mhm.
yes. Yeah.
Okay. Yeah, I'm gonna actually do more research on that. I'm not sure, but I'll do research on that.
I keep hearing it was a good one too. So go ahead.
Grab Sarry's email from the chat and send him an email. I think that would be cool.
Thank you very much.
Thank
Yeah,
you.
thank you.
Guys, any other questions? Feel free to unmute or post your questions.
Yeah, yes, Sarry, how are you?
Hi.
Great presentation. I have a question about, so these are whole life policies.
Mhm.
I can put a lump sum in there. Would I be able to hold this policy in a self-directed IRA?
Oh, good question. Now with this, no, it's kind of almost like the opposite of a self-directed IRA. It's separate from it. It's its own, like it's from an insurance company. And yeah, I wish we could do it that way. We kind of get creative if we could, but it's mostly separate from it.
Okay, thanks.
Quick question, if I can get one in, Sarry.
Yeah.
What interest do you pay on assets that are in the policy?
So when you just so I understand the question correctly,
But do you pay around 3% on your own monies that's in there sitting and sloshing around?
No. So when you borrow the money from the insurance company, you pay as a loan, as a policy
I
loan.
understand that part, but let's just say you have just assets in there.
Mhm.
You don't have a loan. What interest do you pay? Is it around 3%?
You're earning around 3% in the policy.
Yeah. Is that a base floor?
That is so with the insurance company, there's going to be two columns. There's going to be a guaranteed column, and then there's going to be a non-guaranteed column. The guaranteed column is typically around 3%, and then plus the dividends, which is the non-guaranteed side, and that'll raise it to around 5% net present value over the course of that policy. If that makes sense.
Because it's a mutual.
Exactly. Yep. Mhm.
Question. Any other questions, guys? Feel free to.
Yeah, these are good questions.
We have a very engaging group today.
Yeah, I was thinking about the premiums. Are there premiums that are due each month? What are say take for instance, a $500,000 whole life policy and the age is 50. What are the premiums going to be?
It's kind of hard to do that right now, but let's just say, for example, 50-year-old, $1 million, maybe $25,000 a year, and then you could pay it monthly, or you could do annual payments.
Well, $500,000.
Half. Then it'll be probably about half of that, about 12,000. Maybe I'm just kind of doing rough numbers right now, but probably about $12,000 a year.
So $1,000 a month.
Yeah, exactly. Yeah.
Okay. Very good. Thanks.
Guys, any other questions?
So when you're younger, I'm assuming the premium will be lower.
Yes, sir. Yeah, correct. Yeah, when you're
that's what I wanted to ask about children, especially my kid. I want to see if I can get one for her to kind of set her on some type of financial path in the future. So I was thinking, so for children, what's the average policy premium?
Yeah, so this is mostly it's kind of hard to say. There's like really no like solid fixed amount. I would say that for a 10-year-old, maybe putting in $200 a month, maybe to $200, $300 a month, you'd be able to pay a substantial amount of her college by the time she's 18 to 20 years old. I could say, I could probably project that.
What?
Any other questions, Chris? Well, again, Sarry, thank you so much. Guys, if anyone wants to reach out, Sarry's website is finassetprotection.com, and he posted his email. Feel free to reach out. This is recorded. So once the recording is available, I will share with everybody. And again, Sarry, thank you so much.
Thank you, Alina.
Guys, have a great evening, and I'll see you at the next meetup.
Thanks,
Bye,
everyone.
everyone.
Thanks for joining us.
Thank you, Lena. Thank you, sir.